as we go through recognizing finance is a system, you typically map it out when it comes to how you want to end up at your end game. How many properties do you want? How much debt do you want to manage? What is your financial number? Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, finance. It's the key to everything. Yes, our life is linked to finance. I actually got a question sent through from one of our avid listeners about the idea of the difference between interest-only property loans and, of course, interest and principal property loans. But that sparked today's show, but that's not what today's show's about. We're going to touch on that, but we're going to dig into the idea that we as investors need to deploy capital into the market. And as we deploy capital, we take on the game of finance. Real estate is just a game of finance with properties at the other end. And again, to build the portfolio we want in life, we're going to have to get in debt for a bucket load of money, millions of dollars. Yes, are you ready to borrow millions of dollars? Let's have a bit of a chat about it. And of course, we'll answer our listeners' question along the way. But hey, welcome back, regulars. Play the program at double speed, get your life back. And all the episodes I've done are lessons on real estate. So feel free to go back in time. But let's have the money conversation. I don't want to be accused of not asking the probing questions. Are you undercapitalized? Do you have enough capital out in the marketplace? If I was to ask you, what is your strategy and what is your maths for retirement? Do you understand what I'm saying? And of course, can you answer the question? How much money do you want in your retirement? How much money are you taking into your 60s or your late 50s? What does that look like? For most people, they're going to need more assets. And of course, if you are not gifted with, bucket loads of free cash flow, you have to pay for loans and, of course, borrow money, other people's money, namely the bank's money, to build an asset base. Now, remember, when it comes to investment, there's a period of time where you go through a phase of acquiring assets. And when you go through acquiring assets, you obviously need to go and borrow money. But capitalists effectively deploy capital and use capital to create wealth. And the best thing about real estate is it's a game of leverage, really like no other asset class. There's not too many other asset classes I know that you can borrow 90% of the asset's worth and leverage the rest and get the growth results and the yield results from that leverage. Real estate allows us to do that. And of course, as we build a portfolio, we're often put in a position where we need visibility, security, and control over the types of loans we go and choose. And of course, to build a portfolio which perhaps pays $100,000 passive income in retirement, we're going to need a few concepts. We're going to need property. We're going to need home loans or mortgages. We're going to need time to gear ourselves and time to get a result of owning real estate outright. A lot of people do that in two different ways. They end up owning real estate by getting growth from real estate and then eventually selling down some assets to pay off in full other assets, which throw out a cash flow return. or they simply are capable of using mortgage structures, debt reduction, and owning real estate over a period of time and reducing the debt burden on the real estate, effectively working out how to pay off even investment loans. Yes, even investment loans. So the alternative, of course, of not being a capitalist and not borrowing millions of dollars is not really a choice at all. It really is the pension. And of course, there's a huge proportion of people over 65 years of age today that have no money in the bank, have deployed no capital, and really basically getting some money put into their bank account by the government, which is not a lot of money. And so we probably want to put ourselves in that position. Wealth is a habit, and one of the foundation pieces to wealth is understanding entities, it's understanding lending, it's understanding bank accounts, and it's understanding guarantees, personal guarantees. So wealth is a bit of a habit. It's a learning curve at the best of times, but when we recognize that finance, for example, is just a system that we have to get used to, we start to go, well, this thing doesn't scare us anymore. We understand it, and we start to take on more debt. Now, there's several ways to take on more debt inside of building a portfolio. You can take on debt in your own name. You can use a company trust structure, and you can even obviously start a self-managed super fund and take on debt inside of a super fund. For a lot of people, they end up building a property portfolio using multiple vehicles, their own name, which is quite tax effective, a trust structure, which has some other advantages when it comes to lending, and superannuation, which is really another entity altogether, but it really is you. It's your money. It's your super. At some point, it's all going to come back to you. And again, that's just another structural way to build this portfolio. But as we go through recognizing finance as a system, you typically map it out when it comes to how you want to end up at your end game. How many properties do you want? How much debt do you want to manage? What is your financial number? And of course, for $100,000 passive income, I say this all the time, for $100,000 passive income, if you're getting paid 5% net of all costs, you need $2 million worth of real estate spitting out 5% net. How are you going to get there? Well, you might buy a $2 million worth of real estate today, spitting out 5% gross today, and it's full of debt. You've just got to work out how to eliminate that debt on that real estate and increase the yield. And over time, real estate rents go up, real estate growth goes up. But obviously, we can use some buying patterns to buy real estate well. But ultimately, real estate, it's a bit of a game of leverage and a bit of a game of holding. Now, remember, there's good debt and bad debt. Credit card, bad debt. Even your own home is not tax-deductible debt. Bad debt. Good debt is debt which you can basically create a deductible concept from. It multiplies money in a different way. And really, good debt quite often comes from income producing assets. If you take on debt that produces income, that is considered good debt. If you take on debt that doesn't produce income, it's kind of considered bad debt. Obviously, car loans, bad debt. Other loans, personal loans, bad debt. Obviously, for us as a borrower, the less bad debt we have and the more good debt we have, or no debt we have, really the better off we're going to be when it comes to our debt to income ratio. And debt to income is an interesting vehicle. Really does, if you manage it well, you can borrow more money. If you earn more money and you manage your debt, you can borrow more money. And really, one of the best principles of becoming wealthy is actually managing your debt to income ratio. If you have too many liabilities, it gets harder and harder and harder to build that magic portfolio to reach the maths. What is your maths? How much do you want in retirement? Do you know your end game? So, really, the idea of wealth creation is the idea of getting your finances in order to create wealth in the first place. And really, the concept when it comes to borrowing money is there's really some principles behind it. The first principle is you've always got to manage your personal finances well, or no one will lend you money. And you think about creating a matrix for borrowing money. This is an important matrix. When lenders assess you and your financial world, they're assessing debt to service, repayments. They're assessing, proof of savings, your age, your stability of employment, other securities you may have, your net worth, how your employment works, and any other passive income you've got in your lineup, so to speak. But certainly when it comes to some terms, you could, for example, learn some ideas around mortgages. You've got things like interest in principal. Interest in principal is just really the idea that a loan is made up of two components. One is the interest, and one is the actual mathematical amount you have gone and borrowed. Now, banks are pretty cagey when it comes to interest in principal. They use a concept known as amortization, whereby really, as you borrow money, if you pay down the home loan is usually spread out over a 25 to 30 year period here in Australia. So when you borrow money for an investment, you might get a 25 or 30 year property loan. With interest in principal, one of the concepts of understanding finance, the visibility behind it, is typically the interest is front loaded on the mortgage. In other words, when you borrow money to begin with on a 30-year loan, and you're paying off year one of 30, you're going to be primarily paying interest rather than the principal. And really, when you look at some of the challenges with a 30-year interest and principal loan, it's, for the most part, very difficult to bite into the principal in the first couple of years of the loan because of amortization, the idea that the interest is very much loaded at the beginning. But as time goes on, you eventually reach paying off the principal. Now, you can get around this kind of concept through setting up things like offsets, redraws, by making extra payments, making sure that your wage goes into your mortgage from literally the hour your human resources team or your payroll team pays it. So you can reduce the concept of paying too much interest by using basically offsets. But offsets is just basically money that sits in a liquid form in another bank account that speaks to your interest payments. So Interest in principal is one way to consider, investing, but so is interest only. Now, when you get an interest only loan, typically what is going on, the funder will give you a interest only loan for a period of time during that 30-year home loan. And they typically offer you 5 years interest only at the beginning of the loan. What that does is it means you do not have to cover the principal at all when it comes to the amount of money coming out of your back pocket. And again, compare that to a 30-year interest in principal. You are basically paying two parts of the loan. Easy way to understand interest only, you're only paying one part, which is the interest of the loan. The challenge a lot of people run into with interest only loans is the loan term basically shrinks at the end of the fixed only period, of the interest only period. So let's say you pay interest for 5 years only, and then year 6, you start to pay interest and principal. You started with a 30-year home loan. Now you've only got 25 years left on that home loan and you've not paid any of the principal. So what happens is your repayments start to be much higher in year 6 because now you've got less time. You don't have 30 years to spread out the loan. You've only got 25 years to spread out the loan. But again, with the right financial management, you can create a structure, security, visibility, and control over what you put together. In other words, if you're saving cash flow with an interest-only loan, what are you doing with that cash flow? Where is it going? What is the money being used for? Are you offsetting your mortgage? What are you doing with the money? And for a lot of people, they use interest only to basically cash flow management. And of course, lenders today, when they're doing their assessments, some of them actually prefer that you do interest and principal repayments rather than interest only when they're looking at your second and third property. But finance is really a game of quite often doing multiple finance loans. You might buy one property, but end up having 4 different loans on it during the life cycle of your ownership. You might start out with a loan which does one thing, then change to another, then actually refinance, then change lender. And so the game of property investment is very much the game of finance. And of course, when you start out building a portfolio, you quite often take on more debt using things like lender's mortgage insurance, which is just a vehicle to insure the lender for lending you money. Now that can cost you a fair whack of cash. That can cost you $20,000, $30,000, $40,000 to do, but quite often that's put back onto your loan amount. And what it allows you to do is go and borrow 90, 95% of a property's value. That's a high level of leverage. Of course, if you put a 20% deposit down and borrow 80%, you typically don't pay mortgage insurance. So if you've got no money, mortgage insurance is not a bad way to get into the market or to build your first couple of property investments. As you start to own 2, 3, 4, 5, 6, 7 properties, the lender will still lend you money, but they will want bigger deposits from you, more money from you being put into a deal to give you cash. They lower your LVR. So it's typically common, the first couple of properties that you might do, you might use lenders in mortgage insurance to get the best leverage. And then again, you may actually, as you grow your portfolio, as you grow your wealth, you may end up buying a lot of properties on 80% LVRs, 70% LVR, sometimes in super it's 60%, all these kind of mathematics. So for sure, when it comes to some principles around lending, you've got to work out how to control buying power. And sometimes I guess people get quite caught up in the cost to borrow money, the interest rate itself, i.e. Westpac can do a loan at 5.9%, but I can go to ANZ and get 5.7%, and then I can go to Commonwealth Bank and get 5.6%. There's nothing wrong with understanding what rates are on offer, but quite often rates have a very different mathematical equation to servicing capacity using different lenders. Lenders have a different debt to income ratio, DTI, for all of them. And it's very common for property investors to end up using different lenders than are traditional because of debt to income servicing. So you might start borrowing money from Westpac, but then by your fourth property, you're looking at Resimac or First Mac or La Trobe or Liberty or Pepper or a ING, just names which maybe if you're listening and building a portfolio you're not familiar with. But they just have a different debt to income servicing ratio. Now, some of the downsides of lenders when you just have one choice to borrow money to leverage, quite often sometimes when you go to borrow money from a high debt to income financier, quite often, for example, valuers and things like that know you're borrowing money off a high debt to income financier. And so they're very conservative quite often when they're doing valuations, for example. Whereas if you're borrowing money off a major like a NAB or a Westpac, they've got much lower debt to income servicing ratios. So they can be a little bit, so the valuers who end up approving the property values are quite comfortable with the deal, the package being put in front of them. So there's a lot of nuances when it comes to borrowing money, and certainly from the type of funding you use to the valuations you get to the mortgage insurance you're using to the type of LVR you're actually going to take into a property deal. But obviously, the idea of this is properties give birth to other properties. If you buy the right property, if you take out the right loan on the right property and it goes up in value and your debt to income ratio is good, you can look at withdrawing equity and having a little property baby. Now, when you have a little property baby, you've got to be very mindful of basically a little concept known as cross-securitization. It's really good to have visibility around this. There's clauses in loan contracts which can lock you up. There's one particular clause known as the all monies clause. And really, if I was to read out the interpretation of an all monies clause, it's the amount owing means at any time all money which one or more of you owe us or will or may owe us in the future under a secured agreement, and this mortgage or either of them, which is basically saying that the bank can securitize you for any money that you owe them. They can come after other things that you have. And quite often what happens if you buy two properties using the same bank, they will cross the security. In other words, you might have one property that's done really well. It's got a lot of equity in it. The other property, for whatever reason, it's gone down in value. The two are linked together. And so though you've made $200,000 on one property, but you've lost $100,000 on another property, or it's gone backwards, your overall gain is only $100,000. Whereas if you use multiple lenders in that situation, you would not be securitized. You would not have two properties being viewed by the one lender. And that's just a reality of banking. That's just a reality of borrowing money off the same group. If you're going to do it, they can do some pretty tricky stuff. Now, I've had situations where clients have been cross-securitized, and they've sold a property and they've thought they're going to get a lot of the value from their sale, but they've been in basically a situation where another asset with the same bank has gone down in value, lower than the loan to value ratio that bank is looking for, which is it can't exceed 80%. So instead of on the day of basically settlement where the clients have thought they're going to cash out and get some money and go and do some other things with their life, while still owning a property which has not performed. What's happened on the day of settlement, the banks actually redirected money into the non-performing, dropped in value property to top up its margin or LVR. And so you can get margin called on real estate if you're cross-securitized. So it's just something to be something to consider. If you've got one property which is not secured against another property, you typically cannot get margin called. And obviously a margin is just an LVR of 80%. If you go below that, you can end up in a place where the funds top that back up. And you can understand it from a funder's position. They don't want to lose money. They also want their money back. So it's just something to be mindful of. And again, particularly if you're going to use your PPR as your first form of equity, home equity, to come into the investment space. We always recommend don't cross-securitize an investment property with home equity. It's not a good idea. You know, no one knows if a black swan event's going to come and everything's going to crumble and fall apart. These black swans, they come every now and then, every 15 years. You really don't want that situation leaning into your family home. You want a roof over your head. You want a level of security. And so this is where a property investment advisory and mortgage team take a good look at mapping out your plan. And it's very common, you know, for property investors to create a hodgepodge of loans. And a lot of it has to be undone if you don't really have visibility around your future plan. It's a lot easier for advisors to work with someone and go, okay, well, based on what you can achieve here, market growth, periods of redeploying capital, let's work out how to get you 3 or 4 loan structures over a 5-year period and 3 or 4 properties over a 5-year period than it is quite often when you just buy a property and you've chosen XYZ bank because of the rate, and then you want to do it again, but they've got certain hooks over you. So for a lot of people, certainly when my team meet them, you would think they're going to build an asset base after a couple of months of understanding your business model. But really what's happening is, for a year, a lot of people are actually undoing a lot of the financial inefficiencies through lending that they've created for themselves. Cross-securitization, wrong type of banks which allow you to leapfrog to another bank. And of course, again, sometimes it's about using brands and names that no one's really ever familiar with. One of my latest loans was with a lender that no one's ever heard of. And that's very normal. That's very normal for property investors, because we're not buying one property. We're buying multiple properties. And there's some good bits to that, and there's some, less fun bits to that as well. Just is what it is. But when it comes to, I guess, the question that came in, interest-only loans, I don't know if we ended up answering it. We've gone on a tangent. We've had a big conversation about finance. But obviously, interest-only loans generally lower your initial repayments. It allows you to keep money in a war chest. It allows you to have a better cash flow profile on your property for the first 5 years. And quite often, the first 5 years of owning a property is probably the most difficult period. You've got a lot of money going out, not a lot of money coming in. Really, that 5-year interest-only period is set up for you to create a bit of a cushion to get to the next stage. What happens over a 5-year period is quite often the market, needs time to adjust to the price you've paid for the real estate. The market needs time for the rents to go up on the real estate. And so if you're paying interest and principal, you've got a lot of money coming out of your back pocket, you can put yourself in a position where you feel very, very vulnerable. And really, the counter argument is sometimes interest and principal, people get overwhelmed with the amount of the cost versus the rent being collected to hold on to the real estate. If you look at the statistics, it's something like most property investors pack it in within under 6 years. And you've got to ask yourself, is that because they come off the interest-only period of time? The asset they've selected is not the right asset. It hasn't actually increased its rental profile, its cash flow profile. And really, actually, the cost to own the real estate may have gone up. Insurance has gone up. Repairs and maintenance keep coming through. And so what happens is people have a reality check on their asset when they go from interest only to interest and principal. And usually happens year 6, because you've gone through that year 5 free hit period. So I would say interest only is good, but it's only as good as the asset you choose to apply to it. Because if you ever come off interest only and start having to pay both interest and principal, on the other side of that, you want low holding costs and decent rents. And really, that's the game of really choosing the right investment property, which has not only capital growth potential, but also rental growth potential. Now, a lot of advocates will say just stay on interest only forever, never pay off the principal of real estate, and just keep it interest only, because paying the principal off is not tax deductible. It's not tax deductible. And really, there's no right or wrong. There's just basically visibility. The visibility, if you pay off principal, that is not tax deductible. So for a lot of people, particularly if they earn a fair bit of money, they really do not want to pay off the principal. And so what happens is they recycle their loan. They try and get a new loan with interest only constantly looking for interest only. Now, some banks actually prefer you to do interest and principal based on responsible lending these days, and they will even look at that more favorably when they assess you, or brokers will look on that more favorably when they assess you for another property loan. So once upon a time, it was always interest only at all costs. Now there's some benefits to interest and principal because for some lenders, it shows responsible lending, and it shows that that you've lowered your debt to your debt liabilities, and because you've lowered your debt liabilities, you've got a better debt to income servicing ratio. It helps your servicing, but interest only is the best way to generally get a tax deduction for investors. And I've got certainly a lot of investors that are quite shrewd at what they do, and they just love interest only. It's all about tax deductions. So it really depends on, again, your game plan, how long you've got to, you're in the cycle for, and so forth. But it will increase your cash flow having interest only. What you do with that cash flow over the 5-year period is an important conversation piece. Do you put it in your offset? Do you redeploy that cash flow into building a deposit and buying more real estate? It's really important you just don't spend the money and go on holidays. And then after 5 years, you come off a 5-year interest only term, and then you get a reality check, because that's what really happens to a lot of people. And of course, interest only can be less than 5 years. It can be 1, 2, 3, 4, but it's very common for investors to be offered a 5-year term. So it's obviously a strategy, and for a lot of people, they use it for a long-term vehicle to avoid tax or get tax deductions. Other people use it as a short-term need to create a bit of a windfall on their first 5 years of ownership, which is typically very hard. You got a lot of money going out of your back pocket, and you don't have a lot coming in. Eventually, real estate grows, and that you're looking for that growth point. And really, that's a strategic move when it comes to interest only. Obviously, paying off the principal of real estate, debt reduction, whilst not being tax deductible, certainly obviously increases your position where you've effectively owned more of the real estate. So as your loan balance reduces over time, you end up owning more of the real estate. You grow equity faster effectively, which is good. And often interest P&I loans, lenders typically offer lower rates. So whilst you can do interest only, you might be offered a higher rate, which kind of, you've got to work out, well, if I just took the lower rate and interest only, am I actually better off? But just understand with P&I amortization, like, lenders are pretty smart about this. They kind of front load it all, so you end up paying no principal off, even though you're on a P&I loan. So you want to use other strategies if you do have a P&I loan. And of course, Some of them are around offsetting. But the main thing to offset typically for most people is their principal place of residence, because there's no tax advantage to a PPR. It's considered bad debt. It's not income producing. So quite often people will pay off their own home first, and then, if an investment property is paying itself off, that's great as well. Now, there is a point where you get rents that are so good that they pay off the loan. Now, remember, as a property investor, there's sort of 3 points to the cash flow puzzle. There's being negative cash flow and getting tax deductions. There's kind of neutral cash flow where really things seem to pay for themselves. Your rent pays for your mortgage, and also covers your repairs and maintenance and your costs to run the real estate. But then there's a point where you're positive cash flow and your rents are paying off your mortgage. And of course, that is a interesting place to be. Positive cash flow is not tax effective because you pay tax on the cash flow. You pay tax because you're earning more from the real estate than you're losing on the real estate. And positive cash flow, it's kind of like, for a lot of people, the ultimate place where you just end up owning property becomes the sweet spot. And of course, the sweet spot on real estate is kind of avoiding the money pit types of assets out in the marketplace, those blunder equity deals which look good on paper, but they're just constantly full of repairs, maintenance. You're spending money on leaky toilets. Instead, you've got this kind of income producing asset. And to go from negative cash flow to neutral cash flow to positive cash flow, it's a journey. It's a journey. From that first 5-year period's a hard period, and that's why a lot of people do interest only to plan for the next 5-year period. But certainly, will your rents be more than they are today 10 years from now? Yes, they will. Will they be double what they are today 15 years from now? If you buy the right property. Now, I've owned plenty of assets for more than 15 years, and the rents are today double on those assets. They, started as a $400,000 property, today renting for $850 a week in rent, worth $1.2 million. Rents typically don't grow as fast as properties can grow in value, but if you've got the right rental profiled property, it will end up positive cash flow. And again, when things become positive cash flow, it's kind of hard not to pay off your mortgages. And then what happens is you can end up in a place where you've got a property paid off, and it's now just simply putting every year thousands of dollars into your bank account. And of course, instead of putting it into your bank account, you can put it into your PPR bank account. If you paid that off, you can start to redirect that cash flow into other properties and lower the debt burden on other properties. You can use one property's cash flow to pay off another property's cash flow. Again, quite often when people work out how to pay off their PPR, they use a property investment property which might have $40,000 a year cash flow coming in, and they pump that rent into the offset of their PPR to lower basically the interest costs on it. They create an offset on the interest costs, and that allows them to rip into the principal on a PPR. So real estate lending, cash flow, visibility, security, the structures you need to build a portfolio. It's all a bit of a bit of a model. And though interest and interest only and interest and principal was really the question today, I wanted to highlight a few other points along the way. So hopefully that was helpful. I appreciate everyone's time. Get out there, get invested, look after your own financial world. Take care, folks. That's it from me. I'll catch you on the next episode as we talk more property. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.